Right guys, well, we are just about 11 a.m. British summertime, and fortunately at long last summer seems to have arrived in the UK. Been waiting quite a while for some decent weather, and we are 10 o'clock GMT, so welcome everybody. Good to see you all here. We're going to be talking a little about what markets are up to at the moment, and we're going to visit something that I'm always very interested in, and that is doing the opposite of what everybody else wants us to do, or at least just what everyone else is doing. I want to be looking in exactly the opposite direction and going contra the crowd. So I want to be shorting the crowd. Whatever everyone else is doing, I want to be doing exactly the opposite, or at least looking to do the opposite if indeed the crowd is not quite ready to turn and run in the opposite direction. Because I look on markets as there's really just a herd of people moving price in a particular direction. And I relate it very much to, remember those old Western films where they'd be on a cattle droving exercise and you'd have the cattle sort of chundering along, and then all of a sudden something would spook them and away they would go. They would stampede, trampling everything in their sight. And then all of a sudden there could be something which would change them. It might be a gunshot or something which is just going to spook them now in the opposite direction, and then they would just stop and then reverse and go shooting back the other way. So here we are guys, that's where I'm coming from with my approach to trading, and it is something which every now and again we get sort of these reversals and they work a charm. Other times we've just got to wait and be patient and sit tight and do absolutely nothing. So let's just kick off. We're looking at the euro at the moment. Now the euro's had a nice little run, and if we look on the daily chart, what we can see is that we've got this consolidation pattern that has been running now really for all of this year so far, and we've had price sort of bouncing up and bouncing down, and here we are stuck in a trading range once again between around about this 128 region and, well, up here at 132. Sooner or later price will break out of there, and what we've seen is that down at these lows the majority of traders were short, and up at these highs the majority of traders were long. So they were positioned on the wrong side of the market, and that is so often the case. And by determining that the majority of people are sort of chasing themselves one way, then what it tells us is that, well, if pretty well everyone is long at these highs, where is the fresh money? Where is the fresh money to really push price that much higher? And if we were to look on the markets in that way, then we can suddenly get a completely different perspective. Now, we're all emotional beings, and we get affected by excitement and depression. We all do, to some extent. I mean, some of us may well be pretty good at masking it. Some of us wear a heart on a sleeve, but we're all affected by it. Even the coolest customer, even James Bond, cool customer that he is, gets himself excited every now and again. And that's what happens when markets go up. When markets go up, and we've got all these green candles sort of moving higher, then that's exactly what's happening. There's excitement. People don't want to miss out. They want to get in there. And that's why so many people will buy at new highs, because of the fear of missing out on a good thing. It's rather like the crowd behaviour that we tend to get when people are trying to grab tickets to a particular event. And consequently, we'll quite often find that on an interesting event, tickets will sell out so quickly. And you can get a bunch of people in the street all going about their business in their own way, and all of a sudden somebody will look up, and then somebody else might look up, and then everyone starts looking up. If indeed there is somebody waiting to jump off a high tower or whatever, is beside the point. The fact is that we follow what other people are doing, and it's something which is totally inbuilt within us, and we really just can't stop doing it. So we've got to be aware that that's what we do all the time, and when we find ourselves getting a little bit excited because we've just seen a breakout on the upside or the downside, just take a step back and have a little think about what our emotions are telling us. Well, they're telling us to get excited. And let me tell you this, that the majority of excited traders lose money. They get excited and they get carried away and they lose money. So it's probably a good idea to try and remain cool, calm and collected at all times when you're in front of a screen with a mouse button in front of you. Right guys, well, let's just consider one of the most interesting markets that there is at the moment, and that is the Japanese yen. Now what we've actually seen with this is that the dear old Japanese yen has been moving, and it's been moving and getting weaker and weaker and weaker and weaker over a period of time, until price decided that it had got just a little bit too far in front of itself and has then corrected on back. And if we just look at this channel, we could just do a little bit of channel analysis and see that price has actually reached the top end of the channel several times, and whenever it has, price has then corrected on back down, and it corrected on back down, and it's then sort of formed a middle channel and a lower channel, and price has now just broken through with one of these corrective A, B, C moves, and this corrective move may well have run its course. It may well have more to go. But why up there at the high did it stop? Now we could just look at this on technical analysis and say, right, well, it's just got itself a little bit overbought. We could say we've got one of these Fibonacci harmonic patterns, which is 3 drives to a top, and as a result it was a foregone conclusion that it would correct, and that would be a reasonable assumption to make. And what we want to do then is to short it until such time as it stops going down. Now we may well have reached that point. We may well have got to the point where it has stopped going down and it's going to bounce on up. But let's just look at this in the context of what it has been doing in relation to the commitment of traders reports. Now, we've mentioned this before, and as you know, it's something that I follow and do like to take a look at. So let's go there right now. Right, I'll just bring this over, and with any luck you can see that on screen. Perhaps you can just confirm that that is the case. Yeah, you can see this this little chart. Now this comes out of the CFTC. Brilliant, excellent, and it's published every week, end of every week, and it's good up to the previous Tuesday. So you know, it's a little bit historical. And what we're looking at is this one more or less in the middle there. It's a Japanese yen. Okay, we've got Japanese yen, and we look just down here, and we've got several categories. We've got non-commercial, commercial, and totals. Now, I'm not interested really in the totals, and I'm not really interested in the commercials, because the commercials will be, well, all sorts of institutions who are pushing things through commercially. What I'm interested in is what the speculators are doing, and the speculators are then these non-commercials. So I want to look at the longs and the shorts. Okay, I want to see what's going on there. Not really interested in the spreads, and I want to look at the number which is underneath there. So we've got that number of shorts. Okay, on the Japanese yen, this is the futures contract of the Japanese yen, and there are 118,000 okay, who are short, but only a minuscule, by comparison, 18,000 or so, 18,500, who are long. So, what we got there is quite clearly, we got the majority, these non-commercial traders, and they are short this market. And indeed, they've been short for quite some little period of time. Now, we can actually view this slightly more clearly. Let me just see if I've got the right one here. And yeah, this is it. Let me just bring it up. The dear old CME, Chicago Mercantile Exchange, are very kind to us, and they've got this very nice display that we can just sort of pop up on screen and see this. And what we're looking at then is this position in the market. All right, this is the end of last week, and see the histogram. Well, the blue are the longs, and the orange are the shorts. And as we can see, the shorts vastly exceed the longs. And indeed, we've actually seen, going right the way back to more or less the end of last year, that the shorts were the people who were pushing this up. And every now and again, it really spiked higher. And this last one, if we look at this in relation to the previous weeks, we can see that people are getting more and more and more and more short. Okay? Selling more and more contracts short. So there's a lot of paper outstanding on the short side. A lot of paper. And what this means is that sooner or later, all of those shorts are going to have to cover. They are going to have to cover at some point. Now, ideally, they are going to be able to short when this chart, which is the US dollar, okay, is much, much higher, and if that's the case, then they'll take a profit. But what actually we're looking at is that COT chart is showing us we've got this build-up in shorts as price is going higher. So, you know, as you can see, it goes to a new high. You get more and more shorts in the market. More people are selling. They're getting excited. Okay? They're buying the US dollar. They are selling the Japanese yen. It goes to a new high. And we find that the COT report is telling us that, yeah, that is the case, that more and more people at the heights in the US dollar are buying the US dollar against that Japanese yen. And they're selling the futures of the yen. Regrettably, they were wrong. And what has happened? The market has just come on back down. And it's come on back down really quite dramatically. That big spike that we were looking at was way back here. Okay? That spike came at just about there. That's where the spike was. And that's where the maximum number of traders had actually bought the US dollar by selling the Japanese yen. And they were wrong. So whenever we've got that spike, whenever we can see that we've got a tremendous number who have decided that they were going to short the market, that's the time to be looking the other way. And that's how I use the COT charts. So let's just consider the fundamentals. You may remember that just over a week ago there was quite a bit of talk, and that had the effect of affecting the US stock market quite considerably. We're going to take a little glance at that in a moment. But what I'm really interested in is this chart. Now, what we're looking at is the JGB market. It's the Japanese government bond. It's the standard benchmark 10-year, and it's the yield on it. Okay. Now, with bonds, when bonds go up, the yield comes down, and vice versa. So you can either look at a chart of the bond itself, or you can look at a chart of the yield, and they will go opposite to each other. They work absolutely in lockstep. They go opposite each other. Now, over a period of time, as we can see, going back to 2009, then we've seen that Japanese interest rates have been coming down, predominantly down. Okay, that's why the Japanese yen is such an attractive carry currency. But yeah, that's probably a topic for a different day. Over here in 2010, in May, the interest rate came down dramatically, but then it moved up really quite dramatically. And during that time, we found that the Japanese yen did actually strengthen somewhat. Well, on down it came, and if I switch this now to a yearly, we can see what has actually happened fairly recently. We had the various statements coming out of Japan Finance Ministry telling us that they were going to do something quite dramatic to get their economy moving again. And what they decided on was to go into QE in a big way and do whatever they needed to do to stimulate economic growth. Well, the Japanese got a big problem, and their big problem is that they've got an ageing population, and the ageing population hold on to their money, they don't spend it. And what they desperately need to do to increase their economic activity is to, well, they should import people. If they were to allow mass immigration, that would probably solve their problem. They would get their GDP increasing because there'd be so many more people exchanging goods and services, etc., and away their economy would go. But of course, that's not going to happen any time soon, and that's just not going to be an option for them. The other problem they've got is that with their currency that was getting stronger and stronger and stronger, then they found that their export competitivity was getting even worse. So what they felt was that it might be a good idea just to allow their currency to reduce in value, which would all of a sudden make their exports so much cheaper abroad, and that money would then be flowing into the country, and it would help their economy quite considerably. The only problem is that there are rules in the G20 that doesn't allow that, because if you decide that you're going to allow your currency to drop down, then somebody else's currency, or a whole basket of other currencies, will go on up, and it will make them uncompetitive. So they dressed it up, called it something slightly different, and as a byproduct, they found the currency weakened. The only problem is that the bond market didn't play ball. Now, in the US, what we've actually found is that the QE effect has actually reduced over a period of time. It's actually reduced the yield on the US government bonds. And so it started to happen over here. But then the bond market took fright. They got very worried. The collective worldwide bond market, of which PIMCO is probably the largest participant, they took fright, thinking, cool, blimey, think of the amount of indebtedness that there's going to be in Japan. Just based on standard figures, the amount of debt that the Japanese are paying an interest rate on means that 24 to 25% of all government revenue, as in taxes, etc., has to go on the servicing of the debt. If that interest rate were to go from this nice low rate down here of virtually next to nothing, 0.25% to 0.5%, If that went up to 2%, then the cost of servicing that debt, just paying the interest, would suddenly nip up to consume around 85% of total government revenues. So you see they're caught in a little bit of a bind. And the bond market took fright and all of a sudden decided that, woo, we're not going to keep buying this paper unless we've got a premium, a yield premium, against the risk of something dreadful happening. And that's what happened there. We get this spike up in interest rates, and that spike up in interest rates then has linked up quite neatly together with this USD JPY. Yeah, and you're absolutely right, Morgan. Guys, could you spare with me half a mo? Won't be a second. Right, I'm back, guys. Sorry about that. Yeah, absolutely. So, the US can get away with it, can effectively get away with what they're doing because of the fact that it is a reserve currency, and the rest of the world has to, just absolutely has to hold oodles amount of the US dollar because it is the major trading currency of the world. The Japanese, it appears, cannot quite get away with it, and consequently we're in for some really very interesting times. Right, now I did mention that we look at this also in relation to what's been going on with the stock market. So let's just take a little look at this one. Right guys, just switched over now so that we've got, on the bottom, we've got a chart of US government bonds, treasury bonds. This is the long bond in actual fact. It's the 30 years, the sort of the benchmark 30-year bond. We probably might really want to run this on the 10-year anyway, but it's the 30-year bond. And on the top chart then, we've got the futures on the S&P 500. Now, as we can see, we've had the bond just moving on up. There we are. Since the crash in the tech crash, do you remember that? Wouldn't be surprised if one or two people in this room really don't remember that. But there was that tech crash. And of course, liquidity was put into the US system, and away the bond went because interest rates were kept down and down and down and down. And then all of this move led to all sorts of bubbles, and most importantly the housing bubble, which burst in 2009. And, well, actually burst in the end of 2007, moving into 2008. So what we then found was that we got this little bit of a hiccup, and this little bit of a hiccup led to an even more dramatic escalation of bond values, and we then get, as we can see, we've got these just picking up the linkage between the two and the dates, where we then had the stock market, which had crashed like crazy, and then it absolutely recovered. But of course interest rates were kept on down, and that led then to this massive rise up. If we just switch this over to a weekly chart, then what we can see is that there is now a bit of a disconnect in that we've got the stock market, which has been moving up throughout last year and into this year. But what's happened to the bond market? Well, the bond market essentially has gone sideways for the last year. It's just gone sideways to down. Now, the stock market is feeding off what is going on with QE, and the stock market really believes that interest rates will be kept down for a long, long period of time. There is open buying of stocks and stock futures by the Fed, and we've also got a tremendous number of companies who are making the most of very, very low interest rates to borrow money to actually buy their own shares back. And that's one of the other factors which is actually boosting, which is just boosting the stock markets throughout the world. Now, it may well go on for a continued period of time, but the bond market has actually taken fright. And we had that little hiccup from when dear old Bernanke dropped a hint that just maybe QE is going to have to tail off. And that was the day when we get that wonderful engulfing candle. But of course, the bond market had already started to take just a little bit of fright. So that's all very well. We're just doing a little bit of intermarket analysis there between bonds and stocks. But let's just go and flip over to this other one now. And the other one we're looking at is, again, we've got the stock market on the top. But down the bottom here, instead of having bonds, we've got the USD JPY pair. So we've got the JAPY. And just look at the correlation. We go back, right? If we go back to the end of last year, November, both have been moving up like crazy. Up, 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 up. Both of them. They are very, very closely correlated. And indeed, I haven't actually got the chart I can put on here, but if we were to do this with the Nikkei as well, the Japanese Nikkei, we will find exactly the same thing. And where you've got a correlation, you can trade a correlation. If you start to see that you've got a market moving with another market, and you get a little area where price then starts to move against that correlation, we then get a little dip down there in the stock market, but we've got this currency moving on up. Then that presents an opportunity to do a little arbitrage. And away we go. Up, 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 up. And we might find that there's another little area where there's an opportunity to maybe just look at what is going on with a bit of arbitrage, where we've got the currency coming back down and we've got the stock market moving on up. Something has to give, so if one were to sell the ES at that point and buy the currency at that point, then would be very, very well rewarded indeed. Morgan, I hope you can sort of hear and see okay, and I hope that applies to everybody else as well. But yeah, those wonderful words, that wonderful phrase, this time it's different. Well, we get those banded around. And of course, what we've got is a new normal that we've got to somehow cope with. We've got to cope with the fact that stock markets are being held up by things other than just the tradition of based on sound money, on companies actually making profits. And if they make profits, then their stock market price goes up, their valuation goes up. But the new normal is that they're being buoyed up by things other than that. And we just need to be aware of that, because we've now got to be clear about considering what the fundamentals actually are. And what the fundamentals are holding the stock market up is largely QE and those effects that mean that companies can buy back their own shares, that the Fed, etc., are actually buying shares and buying futures, etc. That is the new normal, which will change. It will change at some point. Right, guys. Well, there we are. That's had a little view at considering stock markets and the USD JPY, which I think is one of the most fundamental factors in the market at the moment. So on the one hand, we've got QE. Will it continue? Well, my considered opinion is that our Western governments are totally addicted to it. There's an expression, he who rides a tiger can never dismount. And there seems to be no other policy in order to really try and get growth going, apart from pushing more money out there and more QE. And so they're riding that tiger of QE, which I don't think they will ever get a dismount from until such time as the bond market really does take fright in the way in which we've seen that happen with Japan so far. So that's one sort of fundamental factor there. And yeah, nice one, Boyke, nice one, Ian. Yeah, well said. Yeah, you just have fewer shares in circulation, consequently earnings there make more. Companies love it, absolutely, yeah. Bonuses sometimes linked to this. Companies reward their people with share options. Their share options are worth more, etc. So the directors and insiders in a company, they absolutely love it, and it works wonders for them. Right, that's great. Right, so there we are. At some point the party will come to an end, and by looking at things like the commitment of traders, we can start to see areas where we get these big imbalances, and those big imbalances can just give us the heads up that we should be just considering the other side of the coin. Right, guys, now I just want to take a little wander back to looking at a couple of other areas, and let's just look at one or two other things which can help us get on the right side of a market. Now, I've mentioned that we've had right, sorry about that, just get this back in the right way. That's it. Now, I've mentioned that we've had quite a bit of excitement in certainly the euro market, but what about the market of cable, which is one of the most heavily traded pairs? Not the most heavily traded is in the euro. And I just want to consider what is going on with harmonics. Now, a good many people sort of bandy around harmonics, but it works very much on the basis that where we get a Gartley level picked up, and we get it picked up in the right place, which in this case with cable was at 150, and it's at a time when people are getting really quite excited on the downside. And what we found was that the Commitment of Traders report showed us that when price was getting right the way on down here, then the majority of people were the wrong side. Now, let's just see if we can pick that up. Right, and there we go. So we've got the British pound. This is leveraged money again, so these are the speculators. Look at the histogram and look at what that is telling us. The majority of people, okay, were short, have been short for some little period of time, and indeed what they're doing is increasing their short positions. Just when this market is in fact moving up. So once again, they're getting themselves all a little bit muddled up. They're looking at the market the wrong way round. By the way, on down here, if we just look at the maximum, just bring this one back. If we look at this spike, look at the date on it, 26th of the 3rd, we've got this massive short position We look back to this period of time there in March. Look at this. Because the market kept on going down, because the trend was moving down, the excitement in the market was such that just every man and his dog, his wife, his girlfriend, etc., were shorting this. They were shorting it, they were shorting it, they were shorting it. The only problem is they were wrong. And then up the market went. Up the market went. So when we then see the same thing happening again, with the market moving on down and the number of traders getting short gets to really quite massive and what became unsustainable levels, and it hits a Gartley level at a round number with a multi-point reversal, notice the higher low and an engulfing pattern, that, as we now well know, was the time to buy. And there we go. All right, now, yeah, the Aussie is struggling, of course, at the moment, and if we just whiz back to that, what we've seen with the Aussie is that this one has been very, very, very heavily sold. Now, there could well be more on the downside, but it's quite interesting just to look at this fall. So let's just look at what is going on there. Now, as let's see if we can just pick this one up. Bear with me a second. Right, here we go. Let's just put one on top of the other. And what we've actually got is that the market, if you just look at this, how the very interesting thing is that we've got a very, very long position in the market there, going back to March. Of course, you know, the longs were running this on up. They were then wrong at the top. Price then actually came on down and down and down and down, and the shorts were increasing and gradually increasing more and more and more. So the number of shorts in the market right now are not at a massive level. Certainly nothing like the number of longs that there were at more or less the highs, but they've built up really quite considerably. And what that has actually given over this last couple of weeks is that we've got this bottom which is actually built up. So again, we can look at this in relation to what has gone on previously. We've currently got the highest number of shorts in the market, and they're wrong because we've had a little bit of a bounce. Now, we don't know if this is going to snap back. We really don't know if this is going to complete its fifth wave, which will take it down to the 94 region, but just at the moment it has bounced on back up. Today it's forming one of these inside Hallmey days, and it's entirely possible that the rest of this day will complete as one of these inside days. What will become then really interesting is what happens tomorrow, and we might well see a move out of it. But what that COT report is actually suggesting to us at the moment is that there's still quite a lot of shorts in this market, and they're wrong. And so we could still get quite a reasonable little bounce to come back in. So that's the way that I read it, and that's the way that I'm looking at it, guys. Fine. Right, okay, now back to where we were and looking at some of these significant levels. Notice that the euro is moving on, and I suppose we should really just take a little look at the euro FX also. So we've got a very similar pattern to what we've been looking at, where we've got a beautiful little harmonic pattern, and as price came down to this back level, there were quite a lot of shorts actually in the market. But the really interesting thing is that if we look now at the COT, okay, for the Euro FX, what we've actually got is this thing rallying really quite nicely coming out of that pattern. So the back pattern is working, and all the time we've got these shorts who are still quite convinced that the market is actually going down, and they've got it wrong in a big way. So there you go. Yeah, a 5-0 pattern. And just by being aware of the right sort of pattern, looking at the fundamentals, those fundamentals based on what is going on with the market participants, then you can start to pick out an edge in the market. Now, there is, bear with me a second, we want to go and look at the other major market that there is in the currencies, and that is the dollar index. Now the dollar index, if this thing will pop up, okay, this is this little basket of currencies, of which the euro is just over 50%, etc. And of course this thing works in the opposite way to the euro. So the correlation, because of the weighting, is going to be around about 55-56%. Or inverse correlation, I should say. And there's another little secret weapon. And the secret weapon is not a secret because it's published every single day, and it's volume. Now just look at that volume spike that there was. Okay, we got a volume spike. You see that? That histogram is way higher than any other day that there was. Oh, it was the high of the market. Look at that. We've got that day with an engulfing candle which was in the wrong place, and that was the high of the market on high volume, and that was when we needed to sell. So that's the other thing to look for, and that is exceptions of volume, either a lot of volume activity or a very little amount of volume activity. And we so often find that at the ends of trends, high volume or indeed very low volume will lead to a reversal. Oh right, yeah, sorry, and I missed that one. Yeah, in fact I look at the leveraged money only because the rest of it is commercial activity. It is money which is, it is activity which is used to oil the wheels of industry, to provide the various sort of financing that there is for various banks throughout the world, etc. So it's not the scared, excited, depressed money that we can attach to speculators. Now, we're all speculators, and consequently we will sort of fall into that bracket. Indeed, the leveraged money, the actual definition of it is that these are the larger speculators, and consequently that's what we want to be looking at. We want to look at the excited and potentially weak holders that there are, and anyone who is trading with leveraged money on margin, then they are by definition weak holders, because if the market goes against them, their leverage, their 10%, 5%, whatever it happens to be of leverage, means that as soon as the market goes against them, they could be wiped out in a jiff. They can be wiped out in an absolute jiff. So consequently, if there is something sort of fairly dramatic that happens in the market, then, you know, they're going to be the first out the door. And when they're first out the door, we can start to read into what is actually going on. They leave their fingerprints behind, they leave their footprints. And the COT, plus looking at things like volume, plus looking at the right patterns, we can see several of on this chart, will give us a major edge in the markets. So, there we are, guys. Now, with my harmonic trading package, which you've seen here, then that helps me no end to find where these patterns are, find where the important fib levels are, does it all automatically for me. And by combining it with some of these things that you've seen, I've got one or two other little tools that help me find these volume exceptions, then that gives me a real edge in the markets. Right. Well, I'm glad you're saying that, actually, that, yeah, you know, harmonics, contrarian trading, doing the opposite of what the majority of people do. And, you know, there's a very sound and sensible reason for it. And that is, quite simply, that we know the majority of speculators, of traders, and that includes hedge funds and bank traders, they get it wrong. They actually get it wrong in the market. And so if there's anything that we can do, which is the opposite to what the majority are doing, then that has got to give us an edge to be profitable. And that's my way of looking at markets. Yeah, there's a lot to be said in the old books. In the old books. Absolutely right. Right, guys. Well, look, if anyone wants to follow up with me on any of this stuff, then don't hesitate to email me, george@clickevents.co.uk. Ray, good to see you again. All the best. And I've got to say farewell to you right now, because I've got to go straight into a meeting. Got some people waiting with me just now. But anyway, all the best to you, and see you again soon.